Okay, we're back with United Airlines releasing its second quarter results yesterday, and Delta recently returning to a positive outlook on its sales and profit forecast. There are many eyes on the skies these days, at least in terms of investors looking at airline performance. We're joined now by Steve Trent. He's an airlines analyst at Citi Research. Stephen, thanks a lot for joining us. So we've had Delta issue some relatively positive guidance and return from being on the sidelines guidance-wise. Now I understand United's results are looking good. Are things improving for this sector broadly?
Yes, and good morning, and thanks very much for having me. I would say they absolutely are. So what we saw with Delta and United, for example, was very good movement in terms of EBIT to free cash flow conversion, for example. So United Airlines in the first 6 months, and I know it's a little dangerous with seasonality, but if you look at the first 6 months, free cash flow of $3.4 billion, that's against 1H EBIT rather, of closer to $2.4 billion. So that piece of the story looks very strong. And, you know, I'm also encouraged by what management's saying about potential capacity inflection here in the United States.
Right. You say in your note on that last point that United is saying it sees industry supply inflecting down in mid-August. That sounds like fewer seats in the skies, fewer seats in the industry being made available to passengers. And you say that when that trend happened in the fourth quarter of 2024, we saw shares of United rally. Am I correct in reading that that way?
Yes, absolutely. And when we look at what happened last year, let's go back to 3Q of last year, there was a lot of negativity. So we started with the Delta CrowdStrike issues in July. Then we saw on the North Atlantic unit revenue weakness associated with the Paris Olympics. And the domestic market supply maybe a little bit mismatched with demand, as it's currently been given a little bit of softness industry-wide in domestic main cabin. But once that capacity really started to get cut, we saw a nice unit revenue movement, which really led the stock strongly higher in 4Q. And I have no reason to believe that it's going to be materially different this time.
Stephen, I had a question, John Zechner. Regarding, I mean, in Canada here, because of the travel to the U.S. and the Trump tariffs and everything else, we've seen sort of a reduction in movement there. And I know Air Canada's shifted around a lot of capacity. Have the U.S. airlines seen different changes in travel behavior from the U.S.? And are they in the process of shifting capacity because of either fewer going out, fewer coming in, or anything like that, or focusing more on domestic travel? Is this a major concern for them, or is it something they're reacting to or making adjustments for?
Yeah, absolutely. So, you know, what we've seen so far for the U.S. airlines on the international side is actually very good movement so far. Trans-Pacific really looking up, transatlantic still solid. That traditional summer travel season seems to be extending into, you know, the October timeframe. And I think that's at least due in part to many U.S. and possibly Canadian consumers as well. Still many people out there not in the office 5 days a week in person. So that does create some flexibility. Now, certainly we're keeping our eyes on things like what's going on in some European cities, the anti-tourism demonstrations. That's something we certainly want to watch. But at this juncture, you know, the international corridors still look pretty solid.
You've been correct, Stephen, in the past in calling for United's pre-tax margin, its profit margin, essentially, to expand. Where do they stand now, and can they expand further?
Yeah, no, appreciate that. So I do think that you look at the 6-month numbers, you know, they're in the low 7s percentile-wise on adjusted pre-tax margin. You know, we think they can start to approach the double digits over the medium term in terms of pre-tax margin. So you have things that, in addition to what we were just discussing, on domestic capacity coming in a little bit. You have other factors also rolling in their favor, like the company's very good management of seat mile cost and co-branded card remuneration. So looking at these other factors, and as we get this capacity coming in for the entire group, we're confident that United's pre-tax margin is going to grind higher and medium to longer term approach the double-digit level.
So you like company performance, you like the conditions of the market, and you're very bullish on this stock. You've got a buy rating on shares of United Airlines and a price target of $106 per share. That's well ahead of the $88.50 where the stock is right now. What kind of multiple gets you to that target price?
Yeah, absolutely. So we're basically using a 10 times PE on 2026 expectations. And why would I say that? If you look at the network airlines pre-pandemic average historical PE valuations, a 10 handle would be admittedly a little bit above that average. But why do I have confidence in that 10 handle? So the first thing I would say is sort of what I was mentioning earlier. We have EBIT to free cash flow conversion considerably better today than we did before COVID. We also look at network airlines versus discount carriers. The network airlines have seen a substantial earnings wallet share increase versus where they were in 2018 and 2019. So while I think that multiple's a little bit above the historical pre-COVID average, it's certainly not out of range with that historical valuation. The stronger earnings quality today, we think, gets the stock to at least that multiple next year.